Let me, in fact, welcome in Ridham Desai. Ridham, good afternoon. Great to have you with us after a long stretch. So much to discuss. And, let me start off. We've been reading, of course, a whole host of your reports as they continue to come in. But where do we stand right now in this continuing dichotomy between the markets and the economy?
See, the markets are forward-looking animals, so they are pricing in something about what's going to happen to the economy, say, in 6-12 months, not what's happening right now. What's happening right now was what the market was worried, say, in March, when it was selling off so dramatically, right? So this is simple stuff that we all know. What we have actually is that in response to COVID-19, especially the Western economies and Japan and China including, have unleashed dramatic levels of stimulus, both monetary as well as fiscal. And the levels of stimulus are unprecedented in world history. We didn't get this type of stimulus either during the Great Depression or during World War II, or in the aftermath of World War II, or in fact, even after GFC. This size of stimulus has been unseen in living memory, or in fact even beyond that. So this stimulus is going to find its way into asset prices and stock markets, and that's what we are seeing right now. And this is likely a ferocious bull market because eventually this stimulus will find its way into the economy, and the economy, we reckon, will be in a V-shaped recovery globally, even I think in India, over the next several months. So that's what the market is looking ahead to. There is some structural fallout from COVID-19, but I don't think it really applies to India because India is coming away relatively unscathed. And I'm saying this on the basis of where we are on case fatality rates, which is about 2.2%. And that, is not going to alter consumer behavior. In some other parts of the world where we've had higher fatality rates, maybe some consumer behavior will get altered, but that's going to affect businesses idiosyncratically, not the economy as a whole. So spending will transfer to other sectors, like maybe from travel to something else. But, in India, I think there will be limited impact of all this as we come out of these lockdowns and as the infection spreads and more people acquire the infection. And therefore, the population as a whole acquires herd immunity. So that's what I think the market is looking to. Now, of course, in the near term, we've had a very big rally. And do I think the market is a bit overheated? Yes, it is. Can it correct a few hundred points from here? Yes, it can. Should you get very cheeky about it and try and trade it? Well, it depends on what your investment horizon is and what your investing style is. But, my own view is that if a correction comes along, you've got to be prepared to put money to work because there's a lot more to go before this market peaks out. And this is really not an India-centric view. It's a global view. India, in fact, has underperformed emerging markets since the start of the year and is continuing to struggle against emerging markets on a relative basis. And we'll come to that a little later in our conversation.
Touch upon that and how Indian equities have derated and why. But Ridham, first, I think you're right. Market men continue to be in a somewhat cheeky mood. So, when they're looking to continue to buy in even at dips, how much do you feel the spread is actually widening, that people are more willing now to look for quality stocks across the board vis-a-vis those handful of preferred names that continue to be the leaders in the market?
Spreading out. It's spreading out everywhere in the world. It will spread out in India, and I'm sensing that it's already starting to spread out. So I think you're going to get more and more days in which so-called value stocks outperform quality. The broad market outperforms the narrow market. I think the narrow market trade is mostly done. That doesn't mean that the stocks sell off, but I think there's outperformance coming from the rest of the market, as well as a shift away from what we define as quality into, say, cyclicals over the course of the next few weeks. So it may happen now, or it may happen after the market gives you a bit of a correction, but I think that shift is coming.
Ridham, has the definition of quality itself changed per se in the post-COVID times? I mean, if you really were to think of it, what explains the technology boom, your app companies, platforms, be it global or domestic, or for that matter, even some of the pure play FMCG names. Do you think quality in itself has to be redefined as of now?
Big fan of segmenting the market into such baskets. So these cohorts are good for discussion. But really, in the stock market, what you're buying is two things. You're buying a company's ability to generate excess return on capital higher than its cost of capital, and you're buying stocks of companies that can generate excess growth. This combination is what you would call as quality. Some company that can do this persistently year after year is what I would say is quality. Companies that do this occasionally and then get affected by the economic cycle, I think we can call it cyclical. So I'm giving you a very, very broad definition. This is not how everybody looks at it. But value, for example, most people define it as stocks that are trading at low multiples. But in my view, value is when you're buying a business that's got ability to generate cash flow, and that ability is not priced into the stock. Now, the stock may be trading at 30 times earnings, or it may be trading at 5 times earnings. That's absolutely inconsequential to the definition of value, because it's quite possible that the stock that's trading at 30 times is not priced in that business's ability to generate superior returns on equity and superior growth. So I think if you define it like this, then maybe what we can say here is that companies that are more sensitive to the economic cycle, the stocks of those companies will probably start doing better than the stocks of those companies that are persistent cash flow companies. So maybe that's the way you would look at it. But I really don't like these segmentations. I think we focus on businesses that can generate return on capital and cash flow growth, and compare the share prices with what's the ability of that company to do that.
Sure, I completely get your point. So on the parameter of, growth visibility, cash flow generation, and whether the stock prices are actually matching up and showing you that kind of visibility or not, do you think much of the good is already baked in when it comes to IT as a sector, or do you think this is a long-term growth story with valuations still not at the peak?
See, because we all have limited pools of capital, we have to make relative calls. So on a relative basis, I think there's more juice in domestic sectors like domestic consumption or domestic industrials relative to IT, which is highly reliant on how global business shapes up. So I think that's the comment I would make. The relative case, I think, favors the domestic economy. So to that extent, we would be underweight IT. Now, I've been underweight IT and totally wrong, because the sector has done very well over the last 3-4 months. So I could have timed that better. But I am not in a mood to change that view right now. I think I still see some more juice for domestic sectors relative to global sectors.
So, Ridham, we'll get to some of the other sectors as well in a moment, but I want to come back to that point that you made on Indian equities underperforming and why you feel, they have actually been derated significantly, because, at this point when we're seeing opportunity and seeing equities as clearly emerging the asset class of choice, what's really holding us back?
See, on a relative basis, the underperformance and the derating started sometime in the summer of 2015. That's the period when I think the then government started launching a bunch of reforms, which were actually not so good for near-term growth. Also, stocks in India were trading at all-time high relative multiples. So the starting point of relative multiples also was very high. So what were those reforms? We got, in the subsequent months, we got GST, we got RERA, we got IBC. Now, these are all very good long-term reforms, but I suspect they were not so good for near-term growth because they involved disruption, all of them. And that's exactly what we saw, because after demonetization, growth started petering out towards the end of 2017 and has struggled to recover since then. As a consequence of the cumulative effect of these really hard long-term reforms. Now, I think a lot of the dust on these reforms have settled, particularly demonetization, which had caused monetary aggregates in India to collapse. So M3 to GDP, for example, went from 84% to 78%. Currency in circulation dropped from 12 to 6%. Currency in circulation is now back to 13. M3 to GDP is back into the mid 80s. So I think a lot of that pain has been absorbed, and now we should start bearing the fruits of those changes. And in fact, combined with the large corporate tax cut that we got in September 2019, the economy was already on a mend. So we know that in February, India put in 7-year highs on the PMIs. Had it not been for COVID, we would have probably seen 7-8-year highs on GDP growth in the quarter that just went by. So COVID was very unfortunately time for India. It came at a time when India's economy was just about coming out of its slowdown of the last 4 or 5 years. So that explains why emerging markets have outperformed India, and why India is now trading at all-time low valuations relative to EM. Essentially, investors are saying that we're not so sure that India's growth is going to go back to where it was in the first decade of this millennium, and that maybe there has been a compression in India's long-term potential growth from, say, 7.5% to maybe 5.5%, 6%. Now, I don't think so that has happened. I think once we are out of this, I think we should start seeing a reversion to the previous potential growth. We do need to do some more reforms. There are some signs that the government is willing to make some difficult decisions. I was particularly enthused by the proposed privatization, albeit only 5%, but still a very big move on passenger trains. The agricultural marketing reforms that were launched a couple of months ago, and also the proposed labor law changes that a few states are putting in. So if some of these things go through, then I think India will start seeing a reversion to its long-term potential growth rate. And then this relative underperformance, I think, will end. And also one very quick point here is that because of what's happened in the world over the last 3-4 years, and particularly with reference to the US-China trade war, there's growing interest for incremental supply chains to shift to India. And it's taken a while for companies to make that assessment. But again, we're seeing some early signs of some shifts happening. And this could just be, the moment for India to actually capture some of that growth that it has lost over the last 4-5 years. So I'm a little more optimistic about how India's relative multiples and performance may shape up in the next 2 or 3 years. But of course, with that one caveat that we need to continue to see this reform thrust that we're getting over the past few months.
Absolutely, and that really helps us to paint a picture. Ridham, just to add to that, in terms of the financial sector, do you feel we're far better placed? I know that this is clearly not a repeat of a financial crisis that we last saw a few years ago, but nonetheless, with regards to NPAs and what we've been hearing from the banks so far, the commentary has been encouraging. But would you say that we're in the clear, or would you still be cautious?
No, I'm a little, I would say that there is a risk here. There are 2 risk factors that India has. One is, of course, COVID-19. That's very obvious. Now, we've done well so far. And I'm making this comment on the basis of where we are in terms of fertility rates. We have to hold those gains. If those gains go away for some reason, then that will become a risk factor. The second is, the financial sector. It doesn't seem to be out of the woods as yet. And I'm saying this because credit growth remains quite tepid. And the financial sector is not buying into the moratorium that the government has extended, for example, to MSMEs. By now, they should have. Now, what is the problem here? So I think the problem is that in a lot of financials, there is a shortage of capital. And there is also concentration of market share happening. So the big boys are capturing market share both in liabilities and assets. And I think the concentration of performance that we saw start somewhere at the end of 2018 when the ILNFS episode happened, I think will continue for the foreseeable future. So performance in the financials, I think, will get concentrated in the top 4 or 5 banks, largely the private sector banks and a couple of large NBFCs. And I think the rest of the sector will probably struggle. And that's, I think, what's likely to happen in financials, unless we go into a full-blown growth cycle. And, in fact, it's the large banks that are able to raise capital, and they're raising it. So they are actually bolstering their balance sheet. and they are certainly gaining shares in deposits. So they have ability to lend, and once that willingness comes back, then I think they are the ones who will actually corner performance. So that's how I see it happening.
Sure. Healthcare, Ridham, it seems like a no-brainer. We've already seen how the markets have actually, reacted to the way you're seeing the gains across the pharmaceutical sector and healthcare, I should say, not just pharma. But do you think this is a long-term story at play? Or would you say much of the juice is already behind us, given that most of these stocks are already at their long-term averages?
No, I think we are actually at the start. The derating in the healthcare sector was severe, and we're just coming back. And there will be an overshoot, and until that, it will not be over. And there is a secular shift that is likely in both consumption and healthcare, because India's per capita GDP, which is currently around $2,000, gets largely spent on basic necessities. So most of Indian households are spending bulk of their income eating food and basic residence and basic clothes. Now, when that per capita GDP expands, as I suspect it will over the next few years, the amount of disposable income that Indians have will grow. The amount of spending on roti kapda makan is not going to change a lot. And therefore, you have a lot more money at your in your hand to do other things. What are you going to do with that? Well, you're probably going to upgrade your home. You're going to spend on education. You'll probably spend on travel and leisure. You spend on healthcare. You'll do more testing. You'll try and make sure that you're healthy. You spend on insurance. So a lot of these are not expenditures, not all of them. Some of them are saving as well. But the rise in disposable income will give new options to a growing number of households in India, which today is available to a very small number of rich households. And we know what they are doing. They're traveling abroad. They're buying luxury goods. They're upgrading their lifestyle. And that phenomenon will spread to a larger number of households over the next 5-10 years. So I think we're just at the beginning of this healthcare boom. There's going to be more lab testing in India. People are going to be a bit more careful. They're not going to take things for granted. So, for example, or the pharmaceutical companies as well, lifestyle diseases will become more prevalent. So they will see greater demand for their lifestyle drugs, disease-related drugs. So I think this is just the beginning. It's not yet overshot. It's just coming back to averages. It will overshoot when we are finally done with it in terms of share prices.
As limited as the space may be, but does that also make insurance as an ancillary more attractive for our need to make our future more secure?
Absolutely. When I say disposable income, it doesn't mean all of it is spent. Some of it will be saved. And I think there's a growing reason for us to believe that it will be saved in financial products. So India's financial markets have become more sophisticated. There's greater protection here for retail investors. And there's a lot of work that the regulator has done over the last 15, 20 years. So it looks like our markets are safer and our financial products are a bit safer. And therefore, there will be greater interest in them. So whether it's insurance, whether it's equity mutual funds, or in fact, mutual funds in generally speaking, not just equity mutual funds, a lot of these financial services, which were non-bank financial services, I think will do quite well over the next few years.
Ridham, you mentioned the privatization plan, and the first one that comes to mind, of course, is BPCL with the roadshow on, and expectations that the government will try and close that on priority. Is that what you're looking at? Are you also looking at a basket of PSUs that you think may be up for grabs? I mean, what really is the agenda looking like there?
There may be some trades around these privatization activities because some of these companies will be sold at a premium to their growing share price, obviously, because a strategic buyer will see things differently from the way the stock market sees it, and a change in ownership could really trigger some re-ratings. So yeah, these stocks may be worth looking at. I think it's very important to get the first privatization out of the door because we haven't done one in many, many years. And I think a lot of people are waiting to see how smoothly this process goes and how well it's done. So this one, I think, assumes very big importance, both from a macro economic perspective as well as from a stock market perspective. And if it goes smoothly, then I think a lot of investors will start looking at India more enthusiastically. It could be one of those trigger points for India to start re-rating against EM. So yeah, we should watch it very carefully.
What about on the monetary policy side, Ridham? Is there any more room on that front, or what are you factoring in there?
Yeah, there could be some more room. Actually, I don't think the government or the RBI both have burned all their bullets in terms of stimulus. The government has been very careful not to actually put everything out there. So it has left a little bit in its armory, just in case something goes wrong and then it has to do more stimulus. And likewise with the RBI, I think they will have some room as well. On the side, I will mention that this looks like it's going to be a very strong agriculture year. So, food inflation may continue to be a little bit depressed, which may actually take the headline inflation down. So we may even have room on the rate side. But at the moment, I think given what the world has done, India, I think, certainly has more room. I'm not saying it will be used because we may not have that moment where we need more stimulus, but I think there is some more room.
Sure. Ridham, correct me if I'm wrong here, but do you have a bullish call on energy, and would that be restricted again to the divestment stories, or is it a larger basket of energy names that you're looking at?
No, it includes the private sector and the public sector. So we've been constructive on energy. Energy actually got derated also a lot. And in the last, this is a slightly longer term view. So if you look at the last 5-7 years, financials was the sector that led the market and got re-rated at the expense of energy, at the expense of healthcare, at the expense of discretionary consumption. So financials and consumer staples, these are the two sectors that gained share in the index or gained market cap share in the overall market. And these were the three sectors that lost share. So I think there is a reversal that is happening, which is that I think financials will lose share. I suspect even to some extent staples will lose share, and energy, healthcare, and consumer discretionary will gain share over the next 3 or 4 years. It's not a short-term call. It's more what happens in long-term market cycles. We get these sectoral shifts in the market all the time. Energy was a very strong performer in between 2003 and 2007. In fact, most people may not remember that it was the best performing sector in India. It wasn't financials. It was energy that led the bull market before GFC came. This time around, I think it may shift to consumer discretionary and to some extent healthcare and energy.
Sure. Ridham, since you're a keen observer of global data points as well, one is in a peculiar environment where you're seeing dollar weakness that aid the bump up that you're seeing in gold already at a 9-year high, silver catching up already at a 7-year high, and equity markets across the globe largely as well doing well. What explains the dollar weakness? And do you think that this is a trend which is here to stay? Are we going to see further pressure on the dollar going forward too?
It's largely explained by the relatively higher stimulus that the US has done compared to Europe and Japan. So we do see the euro beating the dollar. That's been a call for a while, and that's happened. What's not happened actually is that conventionally dollar weakness tends to also lead to emerging market outperformance. But until recently, we didn't see that. Now, there are some signs that emerging markets are outperforming. But we'll have to wait and see whether that happens. So in 2007, that 2003-2007 period, the dollar was in a secular bear market, and it went down for 5 years on the trot. And emerging markets went up 5 years on the trot. So they did extremely well versus the SPX. We've not seen that outperformances yet. Of course, it's early days, and I don't know whether we're in a secular bear market for the dollar. But the US stock market still continues to be the leader of the pack. So what's happening in the currency markets is not currently being reflected in equities.
So US, of course, is looking closely at the risk of a resurgence, Ridham, and then we have the elections also around the corner. So how much trouble could that create for us? And as we wind up, should I ask you for a year-end target or not this time because we're battling this difficult period?
The US elections, could produce some volatility. Frankly, I don't think it will directly affect us, but yeah, there could be some volatility along the way. The US COVID situation actually is not as bad as it was. And again, that is on the basis of where we are on the fertility rate. So those have actually been declining. Now, there are some commentators who think that maybe it's going to come back in, say, 4 weeks from now. So keep an eye on that. It's obviously something we can't predict with great certainty. But the good news coming out of India, and let me come back to India on this COVID-19 thing, is that this rise, the spread in infections that we've seen since the country started lifting its lockdown, in fact, since migrant labor started moving out in the first week of May, is that it actually creates herd immunity. And these couple of sero surveys that have come are pointing in that direction, including the one that BMC did in Mumbai, is indicating that maybe we're now, because of the spread, acquiring herd immunity. So we'll see. I'm not an expert on this, but I'm reading a lot of stuff. The ICMR thinks that maybe the herd immunity arrives before the vaccine. So these are not necessarily bad things that are happening. So far as they do not get accompanied with high fertility rates, I think it's okay for more infections to happen because that creates, more antibodies and more herd immunity. So yeah, we'll see. The US elections could be a moment of volatility, but may not change the direction of markets, unless, of course, the markets are already overshot by then.